Now I think people are obsessed with every moment, but it's not every moment that you make a killing. It's catching these trends. That's where you make a fortune.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. SD Bullion continues to gain industry market share by being one of the premier low-cost options for physical precious metal bullion buyers and sellers. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today a new guest, E.B. Tucker, the Director of Metallo Royalty. E.B., thank you so much for joining us today.
Thanks for having me.
All right, now the first topic I'd like to discuss is the precious metal markets, because since it seems like mid-November, we've seen quite a bit of a rise in gold. I guess if we want to start with that metal, what is your perspective about the recent rise we've seen, and why do you think it's rising?
Well, I think it goes back a little farther than November. If you look in the summer, we had a really difficult time, let's say kind of July, August area. And what happened then was Vanguard had a metals fund, and that metal fund just closed. And they completely shifted focus to become kind of an all commodities fund. And if you look back at the charts now, that's the time when we formed kind of a definitive bottom. So November was when people started just recognizing the bottom. December's when you formed a nice technical pattern in gold. I went on Kitco in December and called for 1,500 this year, and that's a call that we'll stick with. But it's good for people to look back. When you look back now, you can see the full picture, and I think that picture looks like a metal price that's ready to move.
Definitely. And what do you think has been driving the price? I mean, there's been, talk from the Fed about they're talking a bit more dovishly now, maybe not as many rate hikes. What do you think is the drive for gold to go higher?
All right. So the thing that's really important for people to understand is that you have to understand how someone thinks, right? So I'm always looking at this in a much bigger context than kind of a day or an hour. I'm not looking at a chart saying I want to figure out how to make $5. What I want to do, and what I've done really well in my career, and in fact, it's where 90% of my gains have come from as a professional investor, is identifying what's happening over the course of like 2 to 5 years. Okay. And if you look at what's happened, the tech boom is over. Okay, now tech companies obviously are serious. They're gonna be here forever. They'll consolidate. They'll be kind of something that touches our whole life. But the boom in those stocks has stalled. And so what's going to happen now is every time you get a rally like the one that we've been having the last 4 weeks since the year started, that's a rally that you want to sell. Okay, so each rally doesn't quite go as high and falls a little lower on the pullback. Okay, so as that happens, some people pull money from that sector, which was the boom sector of the last 5 or 6 years, and that money looks for a home. Well, where's it going to go? Okay, is it going to go into just cash? Maybe not, because the dollar doesn't look so good either. Is it going to go into treasury bonds? I don't think so, because if it was, the rates would be a lot lower. I mean, if you look, I'm looking at the Bloomberg right now. 6-month money is 2.47, and then if you go out 5 years, it's 2.53. I mean, these are strange interest rates, so I don't think the money's going there. That leaves gold. And if you look, people haven't looked at gold as an asset that's a safe haven for their money, broadly speaking. Or I'm sure your listeners have, but broadly speaking, hedge fund managers, all these guys, that's not been a consideration for the last, say, 8 or 9, 7 or 8 years, right? And so that's what you're seeing now is you're seeing an interest perk up. And that's why the charts look good. And that's why the metal price looks good. And I think that's going to continue. That's not an overnight trend. That's something that'll strengthen throughout the course of this year and next year.
And what does it look like in the silver market? I know if we look just at the charts, gold and silver trade very similarly. Is it kind of the same story in the silver market?
Silver's got much more volatility to the upside, because if you go back and look at 5 years on a gold chart, gold has gone nowhere. Now, technically speaking, that's good, because what happens when you go nowhere is that you build pressure, and then when you finally make a move, it's got much more horsepower, because that go nowhere process has exhausted all of the bulls, and they've all quit, and then there's no more shorts because there's been no downside. So you're primed up to really make a move. Now, if you look, say 5 years ago, when gold's the same price as today, effectively, silver was over $20. And people forget that. So silver, is down, call it 20% from its average price over the last 5 years, where gold is flat. So I mean, silver's a complicated metal because it's not exactly the same kind of safe haven for big wealth. I think the poor man's gold is still probably like an appropriate moniker for silver. However, they do move together, and a gold silver ratio, over 80, where it's been for quite some time now, is not normal, and historically speaking doesn't last. So it's a great indicator that we're at that point of takeoff. And I think the prudent investor has some of both metals, and you don't need as much silver because, first of all, it's difficult to store, but silver mining equities will have, I think they'll outpace gold on the upside, and it's worth owning a few right now.
In your perspective, then, would it be better to, when investing in precious metals, to focus more on the physical metal, as you're talking about, or also the mining stocks, as you've also mentioned?
So this is the way it should work. You can't buy a mining stock if you have no metal. And the reason why is because mining stocks are the ultimate hot potato. The thing people need to understand listening is that I've visited more mines than I care to visit. If I never saw one again, I'd die happy, man. And I know this business like the back of my hand. Mark my words, it's the worst business in the world. These companies plow hundreds of millions, billions of dollars into the ground, and oftentimes come up with nothing. Okay. And they say, well, if gold goes up, we'll make money. They never end up making money. Now, before I go too far bashing an industry that I've been in for a long time and fill my email box with hate mail later from my friends, let me just say that when gold moves, if gold moves from, say, 13 and a quarter to 1,500, that move in mining stocks is magnified, okay? Because the economics are better for the company that's producing the gold as gold moves higher. So as an investor, your physical gold is not something that you really buy to make a profit. You don't buy ounces of gold or bars of gold or whatever your size is to get rich. You buy those because gold is money. And I don't care what people say. Doug Casey and I have this debate all the time over cigars of, is gold money? Is it not money? Look, it's money. And if you don't believe it, put it in your pocket, fly around the world, trade it wherever you go. Someone will give you local currency anywhere you go. And to me, that's money because you can exchange it for something at any given time. So the mining stocks, now that's a speculation. So your bullion is not a speculation. You're not buying it hoping that it goes through the roof. You're buying it because it's a sound asset. Your mining stocks, those are definitely speculation. Now, let's take this question a step further. I personally buy royalty stocks. And the reason I buy royalty stocks is because royalty companies like Metalla, for example, where I'm on the board and I'm a major shareholder and I was a founder of the company, Metalla today announced that it bought a 1% royalty on one of Atlantic Gold's projects. Atlantic Gold is a very nice company, Nova Scotia area focus. And the thing about Metalla is that it has 1% of Atlantic Gold's one of their projects, and it doesn't have to put a penny into the actual mining process. So if there's a local issue with the mining union or something happens and a spotted trout is damaged, it has to be relocated. None of that stuff matters for Metalla because it's only has a royalty. So I actually, while I have a lot of experience in the mining stocks, I tend to favor royalties. And the way that looks for me is I have a significantly larger percentage of exposure to royalties because that's a business that I understand. It's a business that I can trust, and it's a business that is not characterized by pouring billions of dollars into the ground in the middle of nowhere and then kind of coming up with nothing.
Now, can you explain for our viewers the difference between royalties and mining stocks?
Yeah, it's a great question. It's actually quite easy. So, if a gold mining company has a new project and it's going to produce 1 million ounces of gold per year, which would be a nice project, and you have a 1% royalty, what that means is you'll get 10,000 ounces of gold every year, which is 1% of the company's gold production. Now, if they find more gold and they produce 2 million ounces a year, then you're getting 20,000 ounces of gold per year. So you have an upfront, agreed upon contractual right to a certain percentage of all. It's usually a very small percentage, but to a certain percentage of all of the gold produced on that site. And if there's more gold found, then typically you get something off that too. Now, this business originated, oil and gas in the 70s and 80s. It was an industry where it was very common for people. Farmers would say, okay, you can explore for hydrocarbons on my property, but I want 2% or something of everything. And you have these stories of the guy on his tractor in Texas, and he's the multimillionaire because the corn farming's not that great, but the royalties off of his oil and gas concession is really great. So that's where this business originated, and then Franco-Nevada and Pierre Lassonde kind of brought it into what it is today in the 80s, and they realized we're going to go broke trying to find gold mines. Why don't we try to get royalties on other people's efforts to find gold mines? And that's what brought this into existence today. And you can look at Franco-Nevada, Royal Gold, Sandstorm, Silver Wheaton, which is now Wheaton Precious. These are the premier leaders of the royalty business. And what we did with Metalla 2 years ago was we started a company that investors could buy. We started at 30 cents. Today we're at $1.05. And this is a business that people could buy stock in from day one and could participate as we created value.
Now, you had mentioned a bit before about the gold-silver ratio and how that the 80-1, 80 ounces of silver equaling the value of 1 ounce of gold, how that's really a sign that, something has to change because that's historically rare. So what is your perspective on that, and how low do you think it could go?
Well, so if you look back, if you pull the gold-silver ratio chart and you go back to just say 2000, what you see is that as this ratio gets to 80, each time it gets to 80, it represents an extreme. And I don't know why 80 is the number. I'd love to be able to tell you that there's some reason why 80 is the number. I can tell you that in the crust of the earth, there's about 16 times as much silver as there is gold, and that's a kind of a rough number. I'm sure there's a geologist cringing listening to that because it's probably 16 and a half or something. But basically 80 is a long way from 16. And the last time that the gold-silver ratio was over 80, 2003. So gold went on an epic run from 2003 till 2008. 2009, early 2009, the gold-silver ratio was in the low 80s. 2016, January, so 3 years ago, before we had a big run in the stocks, it was there, and it's there today. So this is only the fourth time since the year 2000 that the gold-silver ratio has been 80. And for people that kind of don't understand what we're talking about, that's the number of silver ounces that you can acquire with 1 gold ounce. So it's the relative value of silver versus gold. And that's what we were talking earlier about the safe haven value for big money for gold. That's when you're running $1 billion family office and you put money into precious metals, you're really putting money into gold because it's a more effective way to put money aside. And silver becomes complicated with storage, and it's a cumbersome asset. So gold tends to hold up a little better. Once investment demand kicks in and you see fund flows into the business, silver tends to rocket. Now, the end of your question is, what does it look like on the downside? I'd start getting worried once you see 60. And then I would say when you see 50, it's probably time to start looking to cool down your investment exposure, because for the last 19 years, that's been a general range. 80 is an extreme on one side, 50 or sometimes 40. You've seen lower. I mean, in 2011, we saw gold silver of 31 and a half, and that's an extreme. But at 50, I would start to say maybe I should peel back my exposure a little bit.
Now, some people in the industry have talked about, if there is a big bull market in both precious metals, we could see even a further extreme to where it has historically been, around 12 or 16 to 1. What is your perspective on that?
For the gold silver ratio at 12 or 16 to 1?
Yeah.
I think it's unlikely. I mean, I think that if that's the case, then while it would be hard to have the discipline to do this, that's a time that you probably want to get mostly out of the gold business. At that price, if the gold silver ratio is 16 to 1, I would say that we've been in such a ripping rally that probably other assets that don't do so well are very cheap. And that's what people need to understand about owning, gold equities or gold royalty stocks or any of these things we're talking about, is that when these things run, I mean, it is the mother of all runs, right? And so when you see that run happen, you don't want to say to yourself, boy, if this happened 10 more times, I'd be a billionaire. What you want to say to yourself is, okay, this has been really interesting. And now the Wall Street Journal front page, they're talking about gold mining stocks, which they haven't done in 35 years. So, I mean, I might be at a point where I need to look around and say what other assets are inexpensive. I mean, as I was telling you earlier, where I've made all of my gains to speak of is spotting these trends that develop over 2 to 5 years. I mean, I bought rental property in 2010. It wasn't because it was cheap. It was because I thought there'd be more renters and there'd be higher demand for property, and we were coming out of a housing crash, and there was nobody buying rental property, believe it or not. Well, today, everybody's buying rental property. I mean, you've got guys that have got home equity loans and they're out buying property and painting it and trying to flip it. That's a market that's too crowded. Okay, so if we see the 16 gold to silver ratio, my guess would be it's a crowded market. Mining stocks have exploded higher. Everything is bubbled up. And the right thing to do at the time, while it's very hard and it's not advice people want, is probably to settle down and look for other things to buy that are cheap. Today is not that day, though. I mean, today is the day where you look at these gold equities and nobody wants these things. There's no coverage on Wall Street. Nobody's interested, and yet their business is not that bad.
Now, what has changed, therefore? You're saying that the normal range for the gold silver ratio is about 50 ounces of silver to 1 ounce of gold, maybe a bit above that. It can fluctuate, but what has changed? Because back in the 1800s and going way back, it was under 20 to 1. So what has changed to make the ratio so many more ounces of silver to 1 ounce of gold?
Yeah, it's probably, I'd say 60 is a good average. Like 63 and a half is the average since 2000 is what Bloomberg tells me. So we're kind of 35% above that, which is an extreme. It's difficult to say. I mean, it's always tough to look back and compare life today to Civil War time. So many things are different, right? I mean, our access to information, our wealth creation, the entire monetary experiment. If you went back and you told Andrew Jackson or someone that what was going to happen with the Federal Reserve and how it was going to make money from nothing and just make it on a computer or something. I mean, it would just be, it's a whole nother life. And so it's difficult to say what caused that 20 to 1 ratio at the time. I mean, I think a much better window is probably 20 years. I mean, I think that's a time where we're not so far removed from 20 years, yet at the same time, 20 years is a good window to look for patterns, and you could even say 30 years, is a good time to look for. And I want you to think about something else too, Elijah, is that There hasn't been a serious discovery in the gold business in a number of years. There was a graph in the Wall Street Journal about this maybe 2 weeks ago, and it was showing how the miners, part of the reason why they're caving in on each other is they haven't invested in new supplies, new mineable supplies in a long time. And so that's a really big problem. I mean, you can't run a manufacturing business if you don't keep ordering supplies. If you're making a product, you have to have raw materials to make that product. And in the mining business, raw materials is mineable ounces. And a couple of companies have, decent run rates of 20 years or something of mineable material left, but some of them have far less. And if you're sitting on 5-6 years of production left, you're going to have to go out and buy more assets. That's going to have to happen. And so what you see is these guys are actually selling assets. They're selling off non-core assets as they merge. And so I think to me, that's how I see it. That's how I see the world. That's how I make decisions with my money is I'm looking at those types of events, because when I look at them, it becomes very, very easy for me to see what's about to happen next. And it's actually, to me, it's been an easy way to make money, because you can get in front of that and then just wait. You don't have to spend kind of all day staring at the price. You could almost look at it monthly. Or I remember my grandfather looking at the stock quotes in the newspaper when I was a kid. And I sometimes think, wouldn't it be great to just look at the newspaper twice a week and see what your stock is doing? I mean, can you imagine? Now I think people are obsessed with every moment, but it's not every moment that you make a killing. It's catching these trends. That's where you make a fortune. If you got into gold stocks in 2003 or in 2009 or in 2016, and you made a fortune. I mean, assuming you had the discipline to become less enthusiastic when things had kind of moved, right? I mean, assuming you could do that, which, hopefully you could, you had a huge move. And I think that's the kind of move that's coming now. I think we're in literally the first inning of that move. We have just seen the players hit the field. And so I think we've got several innings to enjoy that move, people that are positioned properly.
All right, well, E.B. Tucker, I guess we'll have to leave it with that. Very exciting times ahead, it sounds like. And I guess before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Sure. As we mentioned, I'm a director of Metal Royalty and Streaming. The Canadian ticker's MTA, and in the U.S. it's MTAFF. And everyone should check out the website, metalroyalty.com. Sign up for the press releases. We've bought 26 assets as of today. We're going to continue on that track of putting together what I think is the most attractive development royalty profile in the business. And if people want to learn about the royalty business, we have slide decks that explain how it works online. And I can promise you, it's one of the coolest businesses you'll ever be in. It's got higher revenue per employee numbers than anything I know of, including Google. So it's a very interesting business. And I think as gold continues to move higher, like I've predicted, people will see that the royalties are the kind of the premier way to make money.
All right, E.B. Tucker, thank you so much for your time today.
Thanks so much.